Good morning. Welcome to the morning market briefing. Today is Friday, May 22nd, 2026. I'm joined here by my very special guest, junior fixed income analyst, Hannah Russell, who's in studio today. Her sister had a doctor's appointment, so she's over here having some puffs, watching some Tumbleleaf, and is ready to get into the news. But she was very excited to join the podcast this morning. So let's get into it. I mean, let's start off where we always start off, which is the war. We're starting to see some data trickle in to indicate that we're finally seeing the economic effects for real of the war in Iran. You know, the market reacted in real time, as it always does. It really front-loaded a lot of what could be the outcomes of this. But now, you know, we're a couple months in, we're starting to see oil prices really take root in the supply chain. We're starting to see the higher interest rates take root in terms of the economic activity in the U.S. And so we've seen, you know, some of the strong data that we had in the past start to erode a little bit. So we've got a couple charts. I don't know if Hicks is going to put them up there, but the AIA Architectural Billing Survey showed that we had a really sharp slowdown in design contracts in April. So the building that we were seeing, the large construction we were seeing sort of take off has started to slow. I think people are a little bit more of a wait and see now after what was a really strong March. Similarly, the Philly Fed Index, which we've talked a lot about on this call, fell pretty sharply as well, you know, suggesting that the manufacturing strength we've seen, which is really the only manufacturing strength we've seen in quite some time. We've had a couple consecutive quarters of a growth scenario for the ISM. We're starting to see that lose some steam, so we would expect to see the upcoming readings start to fall off as well. While future outlooks strengthened, the short-term impact seems to be eroding very quickly. And you can kind of see that, I think, as you look around. People are starting to feel the malaise of higher oil prices. We're starting to get tired of this war and sort of the choppiness involved with all of it. And I mean, the housing market especially, we've reached a new high for the year on mortgage rates. I think the prevailing rate is now somewhere in like the 660 range. So any expectation that we're going to see an acceleration in the housing market, which is pretty much already dead, well, now we're just, you know, kicking a dead horse, if you will, as things start to slow down. That being said, there was some positive news overnight and sort of yesterday afternoon where we've seen positive signals from both the U.S. and Iran suggesting that has been a narrowing of the negotiation topics that have yet to be resolved. The unfortunate part is the main one for the U.S., which was the recovery of the nuclear materials as well as the shutdown of nuclear enrichment of uranium in Iran, continues to be a sticking point. And then additionally, something that was not on the table but now is a really strong point for Iran is the fact that we need to get the Strait of Hormuz opened. There was some chatter yesterday that potentially there's some negotiations between Oman and Iran about... Anna, sit down, please. Sit in your chair. We got the little one here is trying to grab the camera. It seems that her video stopped, of course, right as we start the call. Showbiz, folks. But those are the two key issues. Everyone continues to say, at least from the White House side, that they're getting closer and closer to a deal. I'm not going to hold my breath on it, but in the meantime, we are seeing, you know, stocks very strong this morning. We're seeing bonds rally quite a bit. We hit, you know, a 466 on the 10-year yesterday afternoon, which is the highest we've seen in quite some time, but it's down about 12 basis points ahead of markets this morning. So we're seeing some positive results there. The 30-year, which we've talked a lot about on this podcast, falling back kind of normal levels. There's been so much talk about how high it was. We started the year, at a 504 on the 10-year or on the 30-year, and right now we're sitting at about a 506. So, you know, end to end, we've basically been flat, slightly down on principal value, but now we're seeing a strong rally there today. So I would expect that to basically be flat for the year. Despite the fact that everyone was calling for, you know, the end of the world last week when we had a 30-year auction go off above a 5%. Along those lines, today we will see Kevin Warsh officially sworn in as the president of the FOMC, and he's going to be doing it at the White House, which is the first time we've actually seen that done since Alan Greenspan was sworn in 1987, so almost 40 years. I don't know exactly how you would read that. I mean, a lot of people are saying that Warsh is going to be a patsy for Trump and that he's going to immediately push to cut rates. But I think that he's actually facing a much stronger uphill battle than people would think. I think the first order of business for him really is just to convince the rest of the Fed that they don't need to hike rates, which, man, I can't think of a worse scenario. I think hiking rates into rising oil prices and a dead housing market would actually really spell some financial doom. And so he needs to get in there. He needs to be assertive and take the bull by the horns and really figure out that situation and get things pushed forward. And notably, I was looking at some stats early this morning, kind of around the yield curve. And what's interesting is that the article was talking about the different levels of trading that go on the yield curve. And so what we're seeing is just an unbelievable activity on everything that's 11 years and in. So the daily average volume year to date has been about $690 billion of trading for everything on the inside of what would considered an intermediate term bond. So people are trying to find the market level there. They're just aggressively moving. We've seen rates become extremely restrictive as the 10-year has risen significantly. The 2, 3, 7-year, 5-year all up. But what's notable is that the average daily volume on the 30-year Treasury, which end to end is virtually flat and considered to be just a toxic trade right now, is only about $6 billion a day. When you're talking about trillions of dollars of securities, that basically means that it's a completely forgotten trade, which I think continues to underline the opportunity there, because there isn't a lot of price discovery. The more something trades, the more accurate the price is. I mean, think NVIDIA or Apple or some of these huge companies that trade just millions and millions of times a day, and sometimes the price doesn't move at all, even though, call it $150 billion, $200 billion in cash trades hand, and the price discovery is very good versus some small cap stocks where the bid-ask spread could be, 5-10 cents a share because absolutely no one's paying attention to it. And so what the price of that is a little more amorphous. And so I think that really considering that with the 30-year Treasury is something that we're doing, obviously, and I think that the math is so aggressively in our favor that we need to continue to use that as a tool where you can put small amounts of money to work and really increase duration on portfolios. And in the meantime, let everything else run off that we bought over the last 3-4 years at the 5% range. And the net of that is going to be very positive in portfolios. And plus, I'm a little bit I'm feeling a little bit bearish on the stock market. We've just seen unbelievable growth in price action year to date, even in light of this war. I mean, we've seen things like what they're calling the Anthropic basket. So the number of securities that are attached directly to Anthropic, which is rapidly overshadowing ChatGPT and OpenAI in the AI space. Those things are up 56% in March. So think some of the chip makers, Intel, ASML, all these high flying SK Hynix, these companies that, kind of were the third tier of the AI trade are suddenly up massively in the last few days. And I think the best thing we can be doing is continuing to opportunistically trim things that are on fire, buy bonds at levels we haven't seen in quite some time, lock those gains in and basically bake in future returns while also raising the floor on the portfolios. Because if this thing does get ugly, if we do start bombing Iran again, I think we'll see some weakness on the equity side, but I think we'll see real strength on the bond side, and we can basically start to bulletproof ourselves or sandbag, around the fort to make sure that we're in a good position heading into what could be a choppy summer. Traditionally people say sell in May and go away. We'll see how that goes. That actually hasn't worked out the last few years. We've seen big rallies in the summertime, particularly after COVID. Moving on, next topic is we've gotten some unbelievable data that's come out in the last couple of days on the next iteration of the GLP-1s. The big news yesterday was that retatrutide, which is Eli Lilly's third generation GLP, it's technically called a GLP-3 because it's a triple agonist. They just got another study finished up and wrapped up, and the effects were pretty incredible, to the point where they're saying that taking retatrutide over a 48-week period at the highest acceptable dose for people who are, obese or diabetic, was akin to having bariatric surgery. So they're seeing weight loss of up to 38% in a 48-week period, and which is just absolutely insane. And there were a number of people who actually had to leave the study because they lost too much weight. And I continue to think this is just an unbelievable growth story. We're going to continue to see massive gains here. And I think that in the overall picture of healthcare costs spiraling out of control, there's some other studies that came out this morning that indicate that all-cause mortality actually goes down significantly for people on GLP-1s. And they're not quite sure what the mechanism is there. But I think it's safe to say that, one of the things that the retatrutide study showed that they saw just unbelievable erosion of the visceral fat, or the fat that's around your organs. They're seeing people with 80% drops in visceral fat, which, a lot of people will say that, what they call skinny fat, which is, sort of having a ton of fat around your organs, which is much worse than having subcutaneous fat. And, that's a big driver of all-cause mortality. So they're showing in the study that lung cancer patients, the rate of progression for advanced disease when you are on a GLP-1 is roughly cut in half. So say, you've got a 12-month outlook and you've got stage 4 lung cancer. If you're on a GLP-1, that could actually increase to almost 2 years. Colorectal and liver cancers also showed significantly statistical reduction. Breast cancer patients showed a similar pattern with progression rates of 10% versus 20%. And I think that this could be a real net money saver, really worldwide. I mean, obviously obesity is a big piece of the healthcare problem and the side effects of that. So I continue to be extremely bullish, probably the most bullish in the office on peptides. I've been pretty open about that. I want to get my hands on some retatrutide. I mean, why not? What could be better than being less likely to die? That seems like a pretty good side effect of taking these kinds of drugs. And, who doesn't want to be aesthetically pleasing? I certainly do. I say that, but I do have a silly mustache. So I guess that's maybe counterintuitive. But Eli Lilly, they're trying to get this thing over the finish line. Once that thing goes live, I would expect Eli Lilly to continue to do well. And then, of course, the knock-on effects of other companies trying to develop similar drugs is going to be really positive. So, something to think about. We've got some data that will come out today. What's interesting, and I've probably talked more negatively about the University of Michigan inflation expectation number than anyone, because it's been so wrong. But I'm looking at the numbers now that are supposed to be coming out this afternoon. 10 o'clock today is when they're going to come out. But we've come all the way back down to 4.6%, which is notably lower than it has been. And it's also notably lower than the expectations coming out of Liberation Day for 1-year inflation at 4.6%. I still think that's high, but I don't think that's unreasonable. And the 5 to 10 year is now down to 3.4, which I think is really starting to show. And I think it's not impossible that if this war is prolonged, that we'll probably see inflation start to get more sticky and feed into, perhaps being in that range. And, the potential for rate cuts may actually come off the table. I think that the Fed's got to get creative. They've got to find a way to get the mortgage rates down. I think there's a number of levers they could pull there. But for the first time in a while, I think, if you're surveying the average person and they think that 1-year inflation is 4.6 and 5 years 3.4, that might actually be a pretty good read of what the average person is actually thinking. And so I'm interested to see where those numbers come in. But if you think about how the yield curve has moved, with the biggest damage being in the 2, 3, 5, 7, and 10 year, that really is an indication of what people are thinking will happen in the next 10 years on inflation. The 30 year being virtually unchanged, I think, is a good indicator that people think that it's not going to last forever. And so we need to be cognizant of that. What is the market telling us? But I think that a lot of that is actually really more driven by the expectations for inflation in places like the UK and Japan, which will probably be more aggressively realized and more quickly realized, is driving global rates. So that's kind of where my head is at least in terms of interest rates on this Friday morning. We've got a lot of stuff happening today. Markets are going to look hot. We're probably going to be trimming equities, looking to buy opportunistically in bonds. The next week we've got consumer confidence coming in on Tuesday. We've got Salesforce and Hewlett-Packard earnings on Wednesday. We'll get PCE inflation, which I would not be surprised because we already have the inputs there. It's going to be more elevated, and that's going to be a big headline. We'll get revised GDP for Q1, Best Buy, Dollar Tree, Costco. So it's going to be a big week. So tune in next week. As always, like, subscribe, tell a friend. Go watch Hannah bounce around on the YouTube this morning just to see what she's up to. She's suddenly very quiet because you heard her name, I think, and she's listening intently. But we'll be back here on Tuesday. No call Monday. Markets are closed, but expect a big week, and we will see you then.